Yeah. Okay, so here we are again today. Our new knowledge. We've had a great month of education, and we are ending the month with an excellent presentation from our own Danny Ruble with Spiegler Blevins. And he is going to talk about cash flow today and how it affects your business and how you can be more aware of what cash flow and cash flow projections mean to your business operations. So without further ado, our friend Danny Ruble.
Hello, hope y'all are doing well today. Like Kathy said, my name is Danny Ruble. I'm a CPA with Spiegler Blevins. I work across the street here, and I'm a tax manager there that focuses on small businesses. As Kathy said, we're going to be talking about cash flow today, and at any point, just feel free to interrupt me, ask a question. I know we'll have questions at the end, but if there's anything that you need clarification on, feel free to ask. The objectives today are to discuss what is cash flow, how do I manage cash flow. We'll probably spend more time on how I manage cash flow and different strategies to do that. We'll talk about calculating what your break-even point is to help you determine whether your cash flow is matching your profit and what the difference is between profit and cash flow. We'll talk about budgeting, the big B word. Nobody seems to like to talk about it, but I'll try to make it a little fun and make it give you some tips to make budgeting not the nightmare that a lot of people think it is. We'll talk about monitoring your cash, what steps you can take to preserve your cash, and what steps you can take to ensure that you have internal controls within your business to if you're delegating that responsibility to other people. We'll talk about a couple of ratios. For most small businesses, I don't know that spending a lot of time focusing on ratios is really the wisest use of your time, but we'll discuss 3 or 4 ratios that you can use to monitor how you're doing. And then we'll wrap up with a couple of questions. Any questions anybody has. So basically, what is cash flow? Cash flow is essentially the money that comes in and the money that goes out, and whether it's positive or negative. Cash flow is comes in a variety of forms. It can come in the form of cash sales. It can come in the form of credit card sales that are usually deposited into your bank account anywhere from 1 to 3 days after a sale is posted. Positive cash flow occurs when your inflows are greater than your outflows. At the beginning of the month, if you have more cash at the end of the month than you did at the beginning of the month, then that's positive. Conversely, negative cash flows is the opposite. If you have less cash at the end of the month than the beginning of the month. I had a supervisor one time several years ago when I first got started in accounting that told me most businesses don't fail because they lack great ideas, poor management, poor products. They fail because they run out of cash. And so that's what we're going to talk about today is how to manage that cash. I pulled an article off of Inc.com, and these statistics are from the Bureau of Labor Statistics, and they indicated that of all small business each year, only 2/3 of small businesses will survive the first 2 years of business. 44% will survive after 4 years, and 31% will survive after 7. Cash flow is the predominant factor involved in whether a business succeeds or does not. So I'm talking about profit and cash flow. It's important to realize that profits are not the same thing as cash flow or positive cash. Profit is simply an accounting term of revenues minus expenses. If you're on a strictly cash basis of accounting, you don't have any receivables, you don't have any payables, then your cash flow will come pretty close to mirroring what your profit is. But potentially, things that go into determining whether you have profit or positive cash flow is when you sell a product or a service and you sell it on credit, that's an accounts receivable, that goes into your revenue number. It's not until you actually collect that cash or collect that receivable that you turn that into positive cash flow. One other aspect that can sort of correlate between profit and cash flow is debt payments do not factor into your revenues and expenses as far as determining what your profit is, as far as cash profit, tax profit. I guess a good way to think about it is if you go out and you get a loan or you purchase something on a credit card, you're not picking that money up as revenue when you get the loan or when you use the credit. But when you make the payment back, conversely, when you make the payment back, when you pay the loan, when you pay the credit card, it doesn't count as an expense either. The interest expense will count as an expense, but the actual debt payment will not count as an expense. And so that will skew the profit versus cash flow formula some. As I said, collecting the amount due on the invoice or the sales receipt that's been sold on a receivable, that will obviously increase your cash. Fun part, managing cash flow, collecting receivables. Things that you can do to speed up the collection of receivables are you can do anything from offering early pay discounts to would probably be one of the more liberal ways that you can potentially speed up collecting cash and receivables, to the extreme of you just don't allow customers to charge. You can tighten the credit terms, without offering a discount. So maybe what you've been offering are credit terms of net 30. You could certainly consider changing those to net 10 or net 15, giving your customers a shorter time period to pay. Increasing sales. And I've got beware in parentheses because one of the mistakes that a lot of small businesses make is they focus more on trying to increase their sales versus managing their cash. Sometimes increasing sales doesn't always correlate to increasing profits, increasing cash. When I worked at a bank several years ago, we used to have conversations with customers about they couldn't really tell us whether they were making a profit or what kind of profit they were making, but they could tell us that their sales grew 12% over last year, or their sales were up 20% compared to last quarter. But they really didn't have any idea of whether they were making a profit or not. Increasing sales often comes, what often comes along with increasing sales is increasing cost, whether it's cost of goods, whether it's inventory, whether it's increased payroll. If you're in a production sort of business, it could be higher utility bills, higher inputs. So beware of chasing the increase in sales. Obviously, all businesses want to increase their sales. Ideally, increase in sales is going to increase the cash at the end of the day. But just be cautious, be strategic about what your plan is and what your what your execution of those plans are to increase those sales. As I said, we talked about offering discounts to customers. And it can be anything from 1 or 2% net 10. In other words, you can offer customers a 1 or 2% discount if they'll pay you within 10 days. Otherwise, the invoice would be due with whatever your credit policy is. Whether it's, it's not uncommon to see a 210 net 30. So if a customer pays you within 10 days, they can take a 2% discount. Otherwise, they owe you the full amount within 30 days. So those are ideas. You may, depending on what your product or service is, you may even consider offering a volume discount. If they purchase so much product from you or so much, commit to a certain service contract, you may be able to offer a discount just based on the volume and contract. Loans, lines of credit, and credit cards. I'm going to take these a little step by step. When you go to a bank to get a loan, there's a variety of ways that you can do loans. You can do loans on an installment basis. You can do, a monthly installment basis. If there's something that you need cash for, that you've got a project or a sale that's coming up, but you're not going to get paid until 90, 120 days from now, you may do a short-term note in which you borrow the full amount that you need, but you ask the bank to make just a one-time payment at the end of the term. So whatever that term is, whether it's 30 days, 60 days, 90 days, you'll be, at the end of that term, you would pay the full amount plus the accrued interest, as opposed to having to pay that loan each month as an installment. And it's not uncommon for, it depends on the type of business that you're in. For example, if you're in an agriculture business, you may get a loan for 6 months in the spring to go buy livestock, with the expectation that you're going to pay that loan in the fall from the sales proceeds of selling that livestock. So in talking to the banks, it just depends on who the bank is and what their credit policies are as to, on term loans like that, whether some will require you to make a monthly interest payment, some will allow you to wait and pay all the interest at the end of the term of the loan. Lines of credit, be cautious in using lines of credit. Lines of credit can be more preferable to using a credit card. Oftentimes, lines of credit interest rates can be lower than credit cards. The one, in saying to use it judiciously, in order to help the banks with the regulators want to see you use a line of credit like a line of credit. So you're constantly borrowing and repaying the line of credit. That can be on a weekly, it can be a bi-weekly, it can be a monthly basis. But both banks and regulators like to see the use of line of credits be exercised. Draw money when you need, when your cash flow is short, repay it when you're a little more flush or when those receivables or sales materialize. The last thing that both banks and regulators want to see is a line of credit that's used that you draw the full limit on the line of credit and then you only pay interest every month with no other activity going on the line of credit. Lines of credit are meant to go up and down, and using those can be a source of cash, and it can also be ways to grow your business, but again, use caution. Borrow when you need to, and pay it back when you've got the funds. Credit cards, these are typically going to be probably more of your higher interest rate products. Depending on the type of credit card that you use, some may offer rewards. If you're using credit cards that offer rewards programs, you're going to want to analyze whether you're actually getting the benefit of those rewards. For example, if I've got a credit card that offers me an air mile for every dollar that I spend, that's probably not too bad a deal until you take into account that I only fly once every 5 years. So if those miles expire before you're able to use them, did you really get any rewards from using that credit card? Beware of teaser rates with credit cards. Credit cards will often offer you a teaser rate of a low interest rate for a certain period of time, and then the interest rate will go away, and the rate can go anywhere between 12 and 18, or maybe even higher than that percent. So you'll want to examine the back of the credit card application before you apply. Make sure you understand the terms. Oftentimes credit cards, even though they send you a bill on a monthly basis, your payment is required by the end of the third week. And in order to get out of having to pay interest on those purchases, you'll need to pay it in full by that due date. Even though the statement doesn't end for maybe another week, week and a half, if the credit card's not paid off, the interest will continue to accrue. Talk for a few minutes about determining what your break-even point is. The first step in determining what your break-even point is to get a good grasp, a good handle on what your fixed costs are, what your overhead is. When I talk about overhead and fixed cost, I'm talking about rent, utilities, insurance, payroll, if you have employees. Once you know what those amounts are, you're going to want to add your debt payments. And when you add your debt payments, you're going to want to include both the principal and the interest portion, because this is going to be cash going out. As we said earlier, realize that your debt payments aren't going to hit your profit and loss statement, but they are going to hit your checkbook. At the end of the day, you're in business to hopefully profit yourself. So in helping determine what that break-even cost, don't forget to put an amount in there to pay yourself. At the end of the day, it doesn't do you any good if you're broken even, but you don't have enough to pay yourself. That's kind of a raw deal, and one that obviously you're trying to avoid. Oops. Go back. Come on. Once you know what this total amount is of your overhead, your debt payments, and what you're ideally wanting to pay yourself, if you're selling products, you need to determine what your ideal gross profit percentage is. If you're starting out, this may just be an estimate. If you've been in business for a while, then take a look at what your gross profit has been historically. You'll take the sum of these totals and divide it by the gross profit, and that's going to tell you what your break-even point is. In other words, at the end of the day, after you've got your sales, whatever your cost of sales are, whether it's services, inventory, or products, you subtract your debt payments and you subtract your overhead. That's going to ideally that's going to come to zero. In other words, that tells you this is the top line number you have to generate in order to break even. Anything above and beyond that is going to generate positive cash flow for you. Anything less than that is going to create negative cash flow and may necessitate you either taking loans, lines of credit, or credit cards to fill in that cash gap. The other thing that you can do is if you have funds outside of the business, you may require you to make a capital contribution or a loan to your business in order to fill that gap in.
Dan?
Yes, ma'am.
What was the amount on that? The total of your fixed costs in the fund?
Divide by your gross profit percentage. So if your gross profit percentage is 45%, you would take whatever this number is, divide it by 45%, and that would tell you what your break even, the amount of revenue that you need to generate in order to break even.
So, if you don't mind, tell everybody how to figure that gross profit percentage.
To figure the gross profit percentage is simply your revenue less your cost of sales. If you're selling products, then your cost of sales is your cost of inventory or your purchases. If you're selling services, then you're not likely to have your cost of sales is likely to be very small if you're selling services. You may have some parts or equipment that are part of your services that may go into that cost of sales. Otherwise, gross profit is simply your sales minus whatever it costs you to make those sales.
And then divide it by.
Right.
Divide that number.
Divide the sum of that total by your revenue, and that's your gross profit percentage. Any questions? No, tossed a lot of numbers around without numbers. Let's talk about budgeting and taking control. I'd really like you to make budgeting a positive, proactive experience. When you make a budget, what you're going to do is start off with your break-even point, and then just list your either your overheads, your debt payments, to ideally get to zero. Like I said in the last slide, anything above and beyond that break-even point is going to be positive cash flow. But in making a budget, you're trying to assign. I'm wanting you to tell your money what to do, and so for every dollar that comes in, you're going to use your budget to tell it what to do. In setting up a budget, I would start by making an annual budget and then divide it by 12 to try to determine your monthly budget. Once you've set a monthly budget, it's much easier to go through and revise that budget as needed. So a budget is simply just a forecast or a pro forma of what you think is going to happen. So obviously in January, your utility bills are likely to be higher than they are in June, unless you like to be an Eskimo in June. So in your budget, you're going to want to adjust your budget accordingly. So even though you may know that your utilities are going to cost maybe $20,000 for the year, you know that your utilities aren't going to be $20,000 divided by 12 each month. And so you're going to want to adjust your budget to match what you think your utilities are likely to be. In doing this, if you're just starting out, then it's just going to be your best guess estimate based on where you're located, the size of building that you're in, or the size of space that you're leasing or renting. If you've been in business for a while, you're going to want to look at your historical data. Take a look at what last January looked like, and maybe build in a little bit of an inflation factor there. Like this past January, it was a little colder than what maybe last January was. So your utility bills may be a little bit higher. In estimating what your expenses will be, I would recommend maybe overestimating what your expenses will be, with the ideal hope of that's going to make your break-even point a little bit higher. But if those expenses come in lower than what you had budgeted, then that's going to generate additional cash flow for you, especially if you hit that break-even point.
Danny, if you're getting ready to lease or rent a building, wouldn't the landlord be able to kind of give you an idea at least on some of the utility costs?
They should be able to.
And if you're buying an existing business, sure that
Right.
person selling it should have that.
Right.
Utility companies also will tell you the history of that property.
When you're looking at a budget from a budget standpoint versus a cash flow, do you find it better, like say people that pay you insurance on a quarterly basis, do you find it better that they budget that monthly or do it quarterly, or would that skew the cash flow?
In making a cash flow budget, I would match it to exactly where, when the payment is going to take place. But you may build into your budget, like another line item to save for that insurance payment or to save for the tax payments, such as if you live in Washington County, the real estate taxes are typically due in May and November. Personal property taxes are due in November. So you may build that into your general overhead and then segregate it, put it in a savings account, or just realize that you need to have a certain cash reserve when it comes time to make those payments. In setting up a budget, what I mean by repetitive system to plan and execute your budget, when we're talking about cash flow, you need to probably pick one day a week that you're going to pay bills, and make it a repetitive, whether it's every Thursday, every Friday, every Tuesday. Pick a certain day of the week, unless you're buying a lot of products that offer you a lot of discounts. One day a week should really be sufficient enough to pay your bills. Have a good filing system, whether it's just a folder on your desk or in your desk, one place in your office. Maybe it's right here that when the mail comes in, if it's an invoice, if it's a bill, it goes right here. Pay attention to the due dates on those invoices. Part of managing cash flow, we spent a little bit of time earlier discussing that you can offer discounts in order to try to speed up the amount of cash coming into your business. Conversely, you're wanting to put off having to spend that cash for as long as you can. So when your utility bill comes in, for example, if it's not due until the 10th of the following month and you get it on the 15th, you've got 2 or 3 weeks before you need to pay that bill. Wait until closer to when that bill is due to make the payment, instead of just, hey, I got a bill today, I've got the cash, I'm going to write it out, I'm going to pay it today. I think if you will set aside just one day a week, it will help you manage your cash a little bit more. Gives you a better idea of what your cash position actually is. It allows you to look at your bank, look at the deposits that have come in, and then you can prioritize. If you're running a little short on cash, then this allows you to prioritize the order that you're going to make the payments in. So if you've got a payment that's due on the 10th of the month and you've got one that's due the 25th of the month, then you're not going to want to pay the 25th on the, just because you've got the cash today, and then come the 8th of the month, you don't have the cash, when you could have reversed the two, gotten the 10th paid, had more revenue come in, and then paid the 25th. Part of the budgeting system is also monitoring. You're going to want to compare your budget to actual results. A budget is really useless if you don't use it to compare. And when you're comparing those results, use those results to adjust next month's budget or the next quarter or whatever the time period that you're basing your budget on. Don't allow your budget to stay static. If you've prepared a budget that's based on, say, $100,000 of sales for the year, and then 2 months from now, you get a lot more customers, a lot more business than you anticipated, and all of a sudden, your revenue is going to jump to $150,000 to $200,000 a month. Well, leaving that budget based on $100,000 a month, or $100,000 for the year, doesn't do you a lot of good, because as I was discussing, when those sales increase, when that revenue increases, your expenses are also likely to increase. So I think if you will make a budget, make it first project what your annual budget is going to be, and then knock that annual budget, chop it up into your monthly budgets, and adjust your numbers accordingly. It's going to make your budget more realistic, as opposed to, hey, it's on the wall, this is our goal. If you don't adjust it, then the budget's not really helping you. And that's what leads to a lot of people feeling like they allow their budgets to constrain them. Don't allow the budget to constrain you. As I said, tell your money what to do. And one of the best ways to do that is to compare your actual results to your budget. And also comparing the actual results, if you've been in business for a while, compare your results to historical data. What did January this year look like compared to January last year? It's going to depend on the type of business that you're in. If you're in a cyclical business, it's even more important, because managing your cash, when the good time's good, you've got a lot of cash coming in, but when you know that business is going to slow down, you've got to have a cash reserve to get you through those slow times. As I was saying, make sure you revise your future budget. If your utilities, your payroll, your office supplies, your insurance, if you get a discount for the year for a certain time period, factor that into your budget. That's going to either allow you to have excess cash at the end of the month, or it's going to lower your break-even point. And by lowering your break-even point, that may allow you additional opportunities. If nothing else, it may reduce the stress level. Being a business owner is tough. It's not for the faint of heart. And I think by following some of these steps, it's going to allow you to demonstrate that you really are in business, that this isn't a hobby. And the last thing you want is for the IRS to come in and say, well, you're making it look like a business, but it's just a hobby. And if it's just a hobby, that really reduces what your tax impact can be.
Danny, if for a small business that's working on their budget, do you suggest they put a percentage in contingencies, just in case the power company doesn't increase? Or, do you want it right by a penny, or do you feel like there should be a cushion in there, half of the oops moment?
I think when you're dealing with your expenses, I think you should always overestimate them. That way, when the actual expenses come in, ideally they're going to be lower, and that's going to help you establish that cash cushion. Internal controls. If you are delegating the cash management to an employee, there's a couple things that you're going to want to do. You're going to need to determine who has access to your checkbook. who has access to your credit cards? Which employee have you designated that can make lines of credit draws at the bank? Not only is it important to realize who it is that you've designated to do that, but you're going to want to do some things to make sure that they're doing what you delegated to them. For instance, you're going to want to open the bank statements. Make sure you flip through the check portion of your bank statements. Make sure that the checks that you signed actually got cashed or were actually went to who you said you were sending them to. Credit card statements. Are you reviewing your credit card statements? Are you ensuring that if you've designated employees, if you've given them credit cards, that they're not making personal purchases? I know sometimes you get in a hurry, you use the wrong credit card by mistake. You know, did the person repay you for that if they use the wrong credit card? Make sure that in addition to checking your credit card statement for improper purchases by employees, you're also going to want to check to make sure that just general fraud, that you've not been hit by some fraudulent scam or some fraudulent charge. Even though we're in an electronic age, it happens. My wife and I, we got a phone call right before we went to church a couple of weeks ago, and somebody was trying to use our credit card to buy jewelry in China. I have no idea how much they were trying to put on the card, but clearly the credit card company caught that. But that won't always happen, especially if it's a business card. Depending on, I think regardless of what type of business you're in, if it's a business credit card and the credit card company has it designated as that, they're not going to monitor the charges as closely. For example, I work for a CPA firm. I went down to Best Buy this morning to buy the clicker here. Credit card company is not going to say, hey, this guy only uses his credit card 2 or 3 times a year and never at Best Buy. They're not going to call the firm to say, did you authorize this? Now, if there are some truly extraordinary charges, for example, say you never charge more than $5,000 a month on a credit card, and all of a sudden somebody tries to hit your car for $50,000, you may get a phone call in that instance. But as I said, with a business credit card, don't rely on the banks, don't rely on the credit card company to do that monitoring for you.
My father, I started looking at his credit card bills, and he had ordered something off of some special offer on TV, and they were charging him monthly for additional services that he had no idea to get. So he bought, I don't know what it was, earrings for my mom or something. And they, during the questioning process of taking the order, they asked him things about, well, would you like this free membership to this, and do you want free for that? But the free was only for 30 days. And so he had been paying for a year. Additional, it was like $13 a month or something, but for you just never know what all kind of charges are going to show up in the credit card when you do orders over the telephone.
And when you're a small business, every dollar counts.
Yeah.
As I said about reviewing the bank and credit card statements, make sure you're the ones opening the credit card statements, the bank statements, or make sure that the statements are being emailed directly to you. Had a client a couple years ago that the person that, it was the CFO, was opening the bank statements and was manipulating the bank statements with the checks that he had written for it to himself, with duplicate copies of other checks and taping them on there and then scanning the bank statement and then giving the bank statement to the owner. So make sure that, again, that you're the one opening the bank statement, the email's coming directly to you, or that you're logging into the bank account or the credit card to review those. Ratios, these are kind of accounting, I won't say geeky ratios, but some of them are. The current ratio is just your current assets divided by your current liabilities, with current assets being defined as cash, accounts receivable, and inventory. Your current liabilities are whatever bills that you have that are due plus the current month's debt payments. Ideally, you'd like that current ratio to be a 2 to 1. So in other words, ideally, you'd have $2 worth of assets for every dollar of liability. That's not a hard and fast rule. That's probably more like a centuries-old rule. But depending on the type of business you have, whether it's cyclical or you know, the current ratio can certainly be higher or lower. The quick ratio is very similar to the current ratio, except the quick ratio is cash divided by current liabilities. This is going to be, the ideal ratio here is 1 to 1, or not any lower than 1 to 1. If it's lower than 1 to 1, that means you don't have enough cash to pay your current liabilities. And that's where you may need to look at utilizing credit cards, lines of credit.
So that was cash divided by
Current liabilities. Or it may require you to make a capital injection into your business.
So when you say current liability, you know, we know that the definition of current liability is anything that's due within a year, but when you're talking about doing these ratios, it's what's due in 30 days.
30 days, right. The operating cash flow ratio, this is going to be taking what your operating cash flow is and dividing that by current liabilities. Your operating cash flow is basically your profit, add back your debt payments, and add back any capital investments that you've made, such as fixed assets. And that's just a really quick rule of thumb to get to what your operating cash is.
Can you say that again? It's what, divided by your current liabilities?
Your operating cash. What this ratio will do is it will tell you how many set. Sorry, let me look at my notes. This ratio is telling you the number of times your business can pay off current debts with cash generated during the same time period. Whoops. Ideally, that ratio is going to be anything greater than 1. And that simply means that you're generating enough cash during the month to pay your current liabilities. I got it.
So seeing as we're speaking of cash, you would add back in, if you took out anything for depreciation in there too, I assume?
Right, you would add back your depreciation. I wouldn't spend, like I said earlier at the beginning of my presentation, I wouldn't spend a lot of time looking at your ratios. Each of these ratios are going to fluctuate on a daily basis. You may want to take a look at them maybe on a monthly basis at month end, after you know what all your current liabilities are.
And in your experience, what's probably the top 2 or 3 ways that your clients have gotten into trouble when it comes to cash flow? Because you probably have to get them out of it.
Generally, spending too much on fixed assets right off the bat. Fixed assets can be a good way, can be a good tax write-off, but at the same time, if those fixed assets aren't helping you generate revenue, if those fixed assets aren't making your business run better, that's certainly one way. The last thing you want to do is buy a piece of equipment for the tax write-off, throw it in the corner, and 3 years later it's still sitting there in the corner. It's not really a wise investment of cash. Not paying the payroll taxes on time. The IRS is not accommodating at all when it comes to paying payroll taxes on time. They're certainly more flexible in allowing you to pay your income taxes, but when it comes to payroll taxes and payroll tax withholdings, they take that very seriously because you essentially withheld that money from somebody's paycheck, and the penalties and the interest and penalties on that can be quite substantial and can actually be more than the amount of taxes that were due to begin with. And so if that's an issue, then that's going to eat your cash away very quickly. I think probably the third item would be business owners taking too much cash out of their business, not preparing for tomorrow, having a plan B if revenues don't materialize, if receivables don't come in, if you had a great month and just sort of a belief that, hey, every month is going to be just like this. That can put you in a cash hole very quickly. Any other questions?
In your experience, what would you say the average is that you've seen that it takes for your, and again, I guess this is kind of a loaded question, for like a business, say when they start off with a negative cash flow and they're needing that working capital flow them through, what, from a new starting business, what is that turnaround time to get to a positive cash flow? I know that's a loaded question because it's going to vary, but what would you say average is?
Well, I mean, I don't think there really is an average because it depends on whether, are you selling product or are you selling services? And that can be, a big factor because if you're selling services, then it's generally just getting out there, making the sales, generating the revenue, providing the services, waiting for that revenue to come in. If you're selling inventory, then, you've got probably an investment in inventory and purchases. And again, you're waiting for that to come in.
And it depends on how much of that revenue you expect, because, I had a gift shop and a hair salon. Well, I can count on $15, $20 every 30 minutes in the service side. But I might have items over there that I paid 1 cent for and sold for 10 cents. You have to sell a whole lot of 10-cent items to get that $40 an hour. So it depends on what you're selling and what your investment is in.
Some businesses, they're positive cash flow after a week. Others, it can take 5-6 months. Obviously, if it goes more than a year or two, you're probably going to be one of the 44% that doesn't make it 2 years.
I guess that was my general question, is at what point in time do most businesses realize that, hey, this isn't a big problem?
I think that typically that point comes when they've exhausted their personal savings, or they've eaten as much of their personal savings as they're willing to eat, and or the bank has extended them as much credit as the bank feels like the risk is worth. So it's sort of a combination of the two, of what are your outside finances resources willing to make available to you, and compared to what's your personal threshold for paying. I mean, you could easily run up $40,000, $50,000 in credit cards, personally. If you really believe in your business and you've got that high, pretty high threshold for paying, it may be worth it to you. For others, it may be, 15 or 20,000. Maybe the most they're willing to, go in the hole, as far as personal investment before they say, made a good run, this just isn't going to work.
I consulted with somebody that thought he couldn't get through to me, that he was going to be an LLC or some sort of corporation, therefore his personal assets weren't going to come into play. And it was at least an hour and a half conversation. And, I finally kind of gave in and said, well, then you need to talk to your bank, because people, even though the rules say that an LLC or subchapter S or C Corp or whatever, even though the rules say they are an entity, after the banking crisis, the banks don't just, if you don't have enough assets for them to repossess, they ask for your personal assets, whether you're a separate entity or not. And so that is a change in the banking regulations that happened after 2008, that people just don't, they still don't understand that, because they learned in school for so many years that was a separate entity that's not liable for, that their personal assets are not liable for. That is just not true anymore with banks.
And that's how we operate at GQ Capital. We look to see who the owners are of the company, and anyone that has over 25% ownership, we require personal guarantees from them.
I think, and Sandy can probably speak to this just as much as you, but if you don't have self-investment, it's hard to get.
Right.
Plain and simple. So, like Kathy was saying, at some point in time, what may not legally be binding is sometime or another will be tied in financially with it. So.
Yeah, most banks, especially local banks, not only are they going to want your personal guarantee, but they're also going to want a spouse's guarantee usually. It would be unusual if they didn't. Unless you're in a fortunate position that you didn't really need the money to begin with. Yeah, you might get away with not having to give that personal guarantee. But
I'm surprised that when people come, and typically you'll see a lot of folks that just want to come and say, well, I just want to use my equipment. And while your equipment may be worth a lot, if the business goes under, the equipment isn't worth anything to you at that point in time. So there's no self-investment. You don't care to lose the equipment that you've invested because you don't have the business that serves the purposes.
Besides that, it's like a car. As soon as it goes off the lot, it loses 20%
Yeah.
value.
Even for a new one, you probably want to look, you wouldn't find the 85%. But the used equipment, it's a lot more than that.
I know when I worked at the bank that restaurants typically have a high failure rate. Typically, banks wouldn't. Typically, they only counted on maybe getting 10 cents on the dollar for restaurant equipment. So it's not. It's tough.
Nobody's knocking on your door looking for it.
Right.
If you have to close on the loan.
Any other questions? thank y'all for coming today. I'd be remiss if I didn't acknowledge that my daughter helped me with the PowerPoint today. I put the slides together, and I'm more of an Excel person by being an accountant. So I sent the PowerPoint to my daughter, and I asked her to make it look good for me. So I'd be remiss if I didn't acknowledge that she helped me.
Give her name so we can give her.
Lily Ruble.
Okay.
Thanks, Lily.
So that you weren't just looking at black and white on the PowerPoint.
Well, thank you, Danny.
Last call for questions.
Last call for questions.
Oh, I have a question.
Sure.
So we use QuickBooks online. Are there reports in QuickBooks? Like I noticed this morning there was a cash flow report. Is that beneficial? Helpful?
Absolutely.
Yeah.
Yep. Your cash flow report will, and QuickBooks will pretty quickly tell you what your operating cash flow is, and if you're wanting to do this operating cash flow ratio. Also, it'll tell you whether the business is generating positive or negative cash flow from operations, as opposed to funding sources, loans, credit cards. That'll be lower on the cash flow report. Overall, it's going to tell you what your overall cash flow is, but you're primarily going to want to look to make sure that your operating cash, that you're generating positive operating cash from that report.
The reports in Quick,
Yeah, well, I looked, but then the challenges is it lists my, like, say, payroll liabilities. I see this listed as a minus. And I'm like, so that kind of confuses me. Do I not have payroll liabilities because it's a minus, or do I have payroll liabilities?
if you're looking at the banking tab, I've got
Yeah.
firsthand experience with this. If you're looking at that banking tab, you are doing yourself a disfavor.
No, I'm looking at a report.
No,
Cash flow.
the minus sign, I'd have to look at the cash flow report, trying to
I have
think.
one right here for you.
I found that when I
I
first
don't
started
see my
looking at
payroll there. I see my
budgeting,
tax
P&L
liabilities.
statements and so forth, I would get confused between favorable and unfavorable. Sometimes negative isn't a negative, right? Isn't a bad thing.
Right.
If it's an account, yeah, if it's account receipt or payable.
So if it's an asset account and it's negative, that means you sold. In other words, if accounts receivable is negative, then you had more sales on accounts receivable than what you collected. If it's positive, then it means you collected more than you sold on receivables. On liabilities, it's the opposite. So if it's negative, it meant that you paid more in liabilities than what you incurred. And if it's negative, then it meant that your liabilities are greater this month or the time period than what they were at the end of last month.
Is there any kind of, like, ideally for me,
Sure.
you know, if I would love, you know, I'm like, great report, you got a cash flow report. I have no idea how to read it. Is there somewhere like that, you know, like that kind of question, well, what's the negative numbers mean, what's the positive numbers mean? Is there somewhere that we can get that information?
Put the question in quotes on Google and it'll pull it up.
I was going to say, you can type in on Google cash flow statement, and it will explain the cash flow statement in more detail, but also compared to the QuickBooks report that I just saw right there, it'll give you more descriptions on the whether cash was used or generated, you know, for those categories.
I see a lot of baby boomers in this room. When I went back to college in 2009, one of the first things that the students taught me was to put any question in quotes in Google, and it would pull up the answer. So, you know, that's still always the last thing I think of to do, but it does work.
No, but if you look at one of those examples on Google, or if you really want to get really geeky and look at an SEC report, a report that's filed with the SEC, it's going to have more detail, and it's going to tell you, you know, whether It'll say cash used for or provided by, and that will help you more readily be able to read the QuickBooks report. It'll give you a better idea of what the plus and minuses mean on that report.
Does the majority of your clients use QuickBooks or QuickBooks Online?
Yes.
I'm just curious, I have a friend who uses Zero.
Yeah.
You put them in Zero?
Yep.
What's your opinion of that?
We've not looked at Zero. Zero is obviously a competitor of QuickBooks. Zero is, I'm not going to say it's a watered-down version of QuickBooks. It's not as robust as what QuickBooks is right now. And with QuickBooks Online, I think Zero might beat QuickBooks to releasing an online product, but QuickBooks is they're the gorilla in the room. Yeah.
Mm-hmm. And
But it's a good product. I know a lot of people that use it.
Well, he likes it, he finds it easier than QuickBooks Online.
Right. So sometimes QuickBooks and QuickBooks Online can almost give you too much information, too many options to choose from when you're trying to report a transaction. And Zero has made it, you don't have as many options. Conversely, you don't have as many reporting capabilities.
And QuickBooks Desktop is much easier than QuickBooks Online, but it doesn't have the same, all of the same benefits. And, when I first signed up for QuickBooks Online in July, it called employees. Well, now, every once in a while, you pull it up, it calls them workers. So,
Yeah, and it calls and invoices, bills.
Yeah.
That drove me nuts.
Yeah.
Because it's like, since when do you, in an accounting system, call an invoice bill? So I'm online when I first started learning, typing up, what is a bill in QuickBooks? Because it would have bill and expenses, not invoices and expenses.
apparently, half of the United States or world has those problems because there's all kinds of YouTube videos that explain to you what certain things mean in QuickBooks. Again, I didn't think to go to it, but Jennifer did.
I wasn't sure what system it was, but I was looking at cash flow, or the cash flow, budget, P&L comparison, and I'm trying to think of the system that the guy used, but he would give percentages, it just gave dollar amounts. And he was trying to compare, and I'm like, well, that's like comparing apples to oranges, I was like, like QuickBooks, the thing I like about it, you can look at the percentages. When you're looking at percentages, you're comparing apples to apples. Right. And he was struggling with that.
I mean, Zero's not a bad program from what I've seen, but it's a lot like the apps on app stores. It's kind of like Apple versus Google. There's a lot more apps with Apple than there is Google. I'm more of a Google person. My family's more of Apple, but that's kind of like QuickBooks and Zero. Right now, QuickBooks has a lot more apps that sync with QuickBooks than Zero. But that's just because, like I said, Intuit's the gorilla in the room. And so that's what folks are trying to accommodate.
It has more options if you learn it all, but learning it all is, I had Danny on speed dial for the first 2 months.
Well, doesn't everything seem to be going into being cloud-based
Yes,
more and more?
yes.
That's why it probably isn't advisable to buy QuickBooks Desktop, because within the next year or two, it's all going to become online. And so your desktop versions are going to be obsolete.
We've been told that Intuit has 95% of their development on the online platform now. So there's very little new coming out on the desktop. I don't know how long it's going to be before they phase desktop out, but I can certainly see it coming.
Anyway,
I have another question. So would you or Spiegler Blevins or both be willing to teach Ebony Knowledge's more classes in this arena? Because it's the light area.
I'll
I'd like
answer
to see
for
you
him.
come back and teach more.
I will answer for him. We're booked through May the 20th, and that is their tax season anyway.
Yes.
So we will do our best to add a few more classes about that. at the, when we start in September, before they get slammed. They have corporate tax returns that are due in October. So we usually try to get them between October and the middle of January.
Now, next week's is small business bookkeeping.
Yes.
And our friends at Pickle Firms, he's doing that. That's next, is it next week too?
Mhm. Yeah, I was going to.
They're not here.
Yeah, they are. Here they go. So February the 7th is small business bookkeeping, and Hickok and Fern is going to talk to us about that. And again, we are a little bit limited when we get CPAs in here as to what time frame they actually have some freedom. So they like to help us as much as they can, and they even come over. We had somebody from Spiegler Blevins last night in the business challenge, so they do their lion's share of work for us on all of our projects.
Oh, wow.
Yeah, they do have to earn a living. I'm not sure why either, but anyway. We do thank you all for coming today, and we thank Danny for taking the time to come and help us out. And tune in next week or come back next week to to finish asking bookkeeping questions and new hints about business bookkeeping.
And that's why we have those evaluations at your desk, is we want to know what other trainings you want, because we're doing this for you all.
Mhm.
It's not for something to do. So,
And I will close with this. The Rotary Frolics will be Friday and Saturday night this week, and we try to raise $15,000 to $20,000 annually that we give away to local children's charities. So consider watching the Rotarians frolic. Thank you.